Welcome back to this session. Today we plan to continue with our discussion related to partnership. In the last session, we touched upon some of the requirements related to partnership, wherein we understood whenever this partnership gets resolved. In such a case, three things are required to be completed. First, this complete realization of assets and liabilities will have to take place, for which we prepare the realization account. Second step will be about closing the books. Okay, so it's effectively about the closing of the books. So the second step will involve preparation of the partner's capital account, and the third step will be about preparation of the cash account. But we also discussed that all of these three accounts will be prepared simultaneously because there are many entries which will be common. So one leg will go to one account and the other entry will go to other accounts. So that's why it's better to prepare all of these three accounts simultaneously. We also discussed that in respect of this dissolution which takes place, it's not necessary that the dissolution will require, or after this dissolution, the realization of all of these assets will happen on a single day. It may be over a period of time, and something around this is very practical, which we understood. And therein, this distribution happens to be in the nature of piecemeal distribution, or this realization happens to be in the nature of piecemeal realization, and that is why distribution will also be piecemeal. Piecemeal means as and when the money will be collected from the realization, it will get distributed to the partners. Yeah. For this piecemeal distribution, we understood that there are two methods. First was about maximum loss method, on which we discussed one example, and I'm just hoping that on this example you are clear, and around the other things I'm also hoping that you are clear. And I also gave you some questions for the homework. So this was all about practicing the questions. I'm just hoping that you are done with your part, and I'm just hoping that you have practiced questions. So can you all quickly confirm about this homework or this practice, which I'm just hoping you would have completed quickly? Over to you. I'm also receiving certain requests from Vijay, and then Bhargavi is asking about illustration 7 all over again. Keshav is requesting for illustration 2. So I'll come to your queries also, maybe just now or maybe towards the end of this session. But before this, you can just let me know quickly whether you have practiced the questions or not, and whether you've been comfortable solving the questions or not. Quickly, over to you. I'm waiting for responses. Okay, great. Meghna has completed. Shubhat has also completed. Nandeshuram has also completed. Sakshi has also been able to complete this. It's good to see. Keshav is saying about illustration 2, there is some problem. Otherwise, he has understood the capital accounts and all. Okay, great. Now, as around this query related to maximum loss method, Bhargavi, because you require this complete solution of illustration number 7 all over again, I don't think that will be possible. So if you have any specific query, then definitely we can have a discussion on this. But if you have to solve it all over again, then this will unnecessarily waste the time of other students which are also around. And you can always go back to the recording and look at this part which is solved in the last session. And my request to all of you will be that whenever you come up with the queries, just try to be very, very specific in terms of your queries. So when you refer the illustration, please let me know the point that we want to discuss. Okay, or maybe if you can just let me know your query instead of just referring the illustration. That will be easier for me to answer and faster for me to answer. Otherwise, if you are not able to do that, what we can also do is we can also note down the queries that you will have, and then in the next session we can come back to you with your responses. Okay, in the meantime, I've received some more responses. Keshav, Bhargavi is saying I tried. Vaishnavi has completed, very good. Shekha has also completed. Pusmita has doubt around illustration number 2. Kaustav has also completed, very good. Vijay Shankar is asking, sir, is that necessary that the partners have to bring in cash to make good the realization loss? Of course, yes. And that will be dependent on the deficiencies, etc., in terms of their partners' capital account. In case they have got deficiencies, then of course they will have to bring in, otherwise, not really. Mohan is asking about brief of what we covered in the last session. Mohan, I touched upon that point in the last session, whatever we have covered. Cost of is saying, so the drawing account and the current account are same. It's not really a drawing account, it's the current account, wherein all of these drawings are required to be recorded. Then I think Shaksham is looking at illustration number 6. Keshav is saying partners capital account, I have got some doubts. As I told you, like, for example, if you are able to specify your query, then I'm able to answer your queries faster instead of just referring the illustrations. That will be helpful. But still, if you have got some queries related to the illustration only, then I would request you to send across your queries referring the illustration and the specific point therein. What I'll do is I'll just look at those queries maybe towards the end of today's session, or maybe after the session, and then in the next session we can have a discussion on this. Okay, but you should send your queries towards the end of the session, not now. Okay, and I'll let you know when to send it. But if you can just specifically give the point, then of course we can have a discussion on this even now. Vijay Shankar is then asking, sir, in certain sums, realization loss is being debited and also credited in the partner's capital account. Why is it so? See, it's very simple, Vijay Shankar. Whatever is the realization loss, that will get transferred to the partner's capital account. So that's the reason. No other reason. Huh? So it's all about completing that account. Otherwise, that account will not come to an end. Okay. Khushbu is saying, sir, please explain cash balance partners capital point. I think you are looking at that last point wherein I told you that it's sort of check. So whenever you complete your dissolution and whenever you will be done with preparation of this realization account and then the partners capital account and the cash account. So one check is that once you will be done with all of these accounts, then the closing balances of the partners and the closing balance of cash will always match, because that is what is required to be distributed. It will never happen that it doesn't match, because if it doesn't match, then of course it means there's some error. And this is something which you would have realized if you would have practiced the questions. Okay. Saksham, as I told you, you need to be specific in terms of your queries. Okay, Saksham wants to understand around the goodwill and the purchase consideration. See, for goodwill, it's all about usage of, I think, a particular method over there. And that has got nothing to do with partnership. You can just look at the method, the way it's solved. I think super profits method has been used, which you would have covered earlier. And as around the purchase consideration means the money which the new firm or maybe the new person would have given to the old partnership to take over that business. And some of the questions around that we also plan to cover today. So I'm hoping that purchase consideration will be clear to you. But as around goodwill, we can just get into this computation from the solution. Still, if you have any specific query, you can just let me know, and then I can come back to your query slightly later. Okay. So now I'll move further onto the next method in relation to this piecemeal distribution. Uma, around this joint life policy, you remember I told you one point that this is also required to be sort of distributed. So let's move on to the next point in relation to piecemeal distribution. Maximum loss method was one of the methods, and now we are moving on to highest relative capital method. Highest relative capital method. This method requires computation of highest relative capital amongst all the partners, and whichever partner will be having the highest relative capital, that partner will start getting the amount which would be realized from any of the assets of the partnership firm. Okay. Now, this is something which is not easy to understand theoretically. So that's why what we will do is, once again, we will go back to the illustration. We'll try to solve that illustration because it will be best understood with the help of illustration only. So all of you, if you can go back to the same illustration that we discussed in the last session, same illustration. Okay. Illustration number 7. Illustration 7, and this was page number 2.32, but now we are looking at page number 2.34. Because on this page number 2.34, the illustration number 7 continues. Okay, so it says the illustration given above, means illustration 7 is now worked out according to this method. So let's see if the facts are all same. You remember illustration number 7? If the facts are all same, then how do we really need to solve this or compute this distribution using this highest relative capital method? So we understand that there were 3 partners, C, B, A, and their partners these partners had a capital of 15,000, 18,000, and then the third one had 9,000. This was the capital which they had, and then we can put down their profit sharing ratio, which was 3:2:1. Okay. Now, under highest relative capital method, what's the first step? First step is to divide the capital of the partners by their profit sharing ratio. So let me just say this is first, this is second. Okay. Now, capital, if that is divided by profit sharing ratio, so what will it become? 5,000. What will it become? 9,000. And this will also become 9,000. Correct? Now in this case, sorry, this is 7,500. This is 2:2:1. So sorry. This is 2 and therefore it is 75. Yeah. Now, moving further on to this, whichever partner has got the lowest capital over here, that should be considered as the base, and that should be the base using which another amount is required to be computed. So now what we will do is we will compute proportionate capital using A's capital as the base. Now let's once again try to understand what is it that we are trying to solve. We are saying that let's suppose this was the base capital, okay, and this base capital has to become the capital so that capital ratio and the profit sharing ratio become same. So what do we do in this case? In this case, this will become 15,000. So we'll have to just simply multiply. Let's suppose this was third. We'll have to simply multiply this with profit sharing ratio. And over 3, we will be only looking at capital of A. So this will not be completely third. This will be third A, for example. Yeah. Once again, what do we do? This becomes 15,000. Okay. Then we will say as a next step, these two will give us 15,000. So what are we doing? We are keeping 7,500 as the base and then multiplying this with the profit sharing ratio. Okay. So what do we get? 15,000 again. Then next is 7,500 into 1. So what do we get? 7,500. By doing this, what is it that we have achieved? By doing this, we have achieved the capital. By doing this, we have achieved the capital, we have computed the capital, which is in profit sharing ratio only. So if you look at this capital, this is in profit sharing ratio. Yes or no? But for doing this, or for computing the capital in the proportionate, in the profit sharing ratio, we wanted some base. Now what would that base become? The smallest amount computed over here. Okay. So now, if the partners had to maintain their capital, in the profit sharing ratio, then their capitals should have been this, and this. But what is the actual capital of the partners? This one. Yeah. What is the actual capital of the partner? This one. So that means either the partners have got excess capital or the partners have got short capital. So let's look at it. Excess capital. If we compare these two, this is not excess. If we compare these two, 3,000 is the excess capital. This is 18,000 minus 15,000. Or for your purposes, you can also say that it is 1 minus 4. Okay, this is 1 minus 4. And over here we get 1,500. So what do we see? That B and C have got excess capital if the capitals were to be kept in the profit sharing ratio of the partners. Is that correct? Yeah. But if you look at A has not contributed capital in excess of the capital which was required to be kept in the profit sharing ratio. Okay. Now, in the given case, what do we do? In the given case, whenever any distribution will happen, so who will be paid first? These two partners. Why? Because they have contributed more capital. So if they have contributed more capital, we will be paying off them first of all. To the extent of the amount which they have contributed in excess of their capital, which should have been there as per profit sharing ratio. Yeah. So I see some doubt from Aditya. Aditya is saying, sir, this formula should not really be 1 minus 4, it should be 1 minus 3. No, Aditya. So it's capital from which? From the capital, actual capital. This is actual capital. No? From the actual capital, what would you reduce? You will reduce proportionate capital, which is 4 only. Now this is 4. Okay, so this has to be 1 minus 4 only. Clear? No problem, Aditya. So now, what is it that we have achieved by doing this computation? We have computed the amounts which would be paid on priority, or you can say preferential amounts which would be paid to B and C before paying anything to A. And after the payment of 3,000 and 1,500 is made to B and C, then the amount will be paid to all the partners as and when it comes in their profit sharing ratio. Clear? Clear on this part? Yeah? Okay, so now we need to move further. And now we need to start the distribution. Correct? I will not recompute everything in terms of the distribution because this illustration we computed and we remember that it was from the third installment in illustration number 7 that the amount became available for distribution to the partners. Remember? Yeah. So we can look at those numbers only. So let's clear this part. Now we are moving on to the distribution. Third installment, total amount was 900. Total amount was 900. Now, will anything go to A? No. Because we understand 3,000 plus 1,500 means the amount up to 4,500 will be distributed to whom? Both B and C. Correct? Yeah. So this amount will go to both B and C. And after this distribution is done, then the distribution will start happening to all these three partners in their profit sharing ratio. Kostav is saying, sir, why we have taken A's capital as the base? Because when we computed the relative capital, okay, when we remember we divided the capitals, actual capitals by profit sharing ratio, it was least for A. So that's why it's been kept as basis. Because only then we will be able to understand which all partners have contributed in excess of their capital. Okay. I think Ayush has computed this. Very good, Ayush. Now the next question which arises and which I am sure will be there in your mind also, that this 900 will go to whom? So it is clear that 900 has to be distributed and it will not go to A, but to B and C it has to be distributed. So in what ratio it should be distributed to B and C? So let's understand. For B, 3000 is excess and for C, 1500 is excess. Correct? Yeah. Let's suppose if we look at their profit sharing ratio. What are their profit sharing ratio? 2:1. And if we divide this, let's suppose if we have to once again compute whether any of these partners have also contributed in excess of their capital. So what do? We will divide their excess amount by their profit sharing ratio. So this will become 1500 and this will become 1500. And do we find this amount on the basis of the same method in excess of their capital? No. This is definitely excess in terms of the actual capital which they have contributed. But amongst these two, the excess which have been given by both of them are in their profit sharing ratio. So that's why this 900 will get distributed to both of them in their profit sharing ratio. Clear? Khushbu is asking, sir, from where did you get this 900? Khushbu, I'm not sure whether you were there in the last session or not. If you go to illustration number 7, you will understand that the distribution is available equal to an amount of 900 and which will be distributed starting from third installment onwards. Okay. So if you were there in the last session, I'm just hoping that you will be able to remember. If you are not there, then of course you need to just revisit the illustration number 7. Okay. So let's distribute this 900 in the profit sharing ratio, 600 and 300. It's gone. Yeah. Now fourth installment. In the fourth installment, what did we receive? In the fourth installment, an amount equivalent to 6,000 was received. Fourth installment, an amount equivalent to 6,000 was received. Now, can this 6,000 go to all? No. And can this 6,000 go to B and C only? No. B and C had contributed 4,500, out of which 900 has already gone to them. Still, an amount equivalent to 3,600 is paid first of all to B and C, so that their excess capitals are paid first. Okay, so what do? This fourth installment, which was equivalent to 6,000, will be broken into two parts, 3,600 and 2,400. And in this case, what do? This 3,600 will go to only B and C. 2,400 will go here, 1,200 will go here. And this 2,400, this will go to all the three partners now. Why? Because if we look at all these amounts, they become equivalent to 4,500. So that means the excess capitals of these two partners are paid through these portions. Now, all these three partners are equal in terms of their capital contribution. So that's why they will start getting paid in their profit sharing ratios. So out of 2,400, 960 will go to A, 960 will go to B, and 480 will go to C. Okay, clear? Clear on this? Yeah. Okay, Ayush is saying, sir, we had something similar to this in BCom, of course, yes. It was not something similar, it was exactly similar. Yeah. So if you're just able to link all of those concepts, then you will find all of these things very similar. And trust me, your subject at this level is not really very difficult. It's very simple. It's just that you need to understand the concept. So we'll move on to the fifth installment now. This was 20,100. So this 20,100 will go to all the partners in their profit sharing ratio. So this is 8040. This is again 8040. And this is 4020. Okay. Yeah. So with this, our distribution is completed. So the total amount to be distributed is 27,000. And this has gone to all these three partners. You can compute these totals and let me know. 9,000 goes to A, 12,000 goes to B, 6,000 goes to C. So this is how distribution will take place under highest relative capital method. Clear? All of you? If you want to look at notes around this method, you can refer to this para number 1.7.2 on page number 2.34. You can mark this para for the purposes of your notes. Okay. You can just consider this part for the purposes of your notes. Aditya is asking, why would A get a share? He doesn't have any excess capital. He doesn't have excess capital, but does he have capital or not? So to the extent of his capital, he will get the money or not, or he will not get anything. So to the extent of his capital, he is getting. Nandishwaram is asking, sir, why we are splitting these in 5 installments? This is because of the fact that you have either not attended the last session or you have forgotten the solution of illustration number 7. So that's why it's very important for you to go back to illustration number 7 and solve it using the method we discussed last time. Meghna is asking, sir, we have to calculate until we find that their capital is in profit sharing ratio? Of course, yes, that's correct. Keshav is asking to repeat it. In this method, very simply, Keshav, if you have to just note down the steps, pick up the actual capital of the partners, divide the actual capital by their profit sharing ratio. The least amount that you get, that will become the base. And using that base, compute the amount that the partners should have contributed. That will be by multiplying that base with the profit sharing ratios. And this will give you the number which is or which should be equal to the actual capitals. If this is not equal to the actual capital, then the amount in excess is nothing but the excess capital. and that excess capital should again be in the profit sharing ratio. Otherwise, we'll have to recompute that till the time it gets into the profit sharing ratio. Okay. Clear, Keshav, on this? Very good. Vasudha has understood this. Aditya also seems to be clear on this point. Great. So now, in respect of this, you should once again note down your homework. Let's say illustration number 9 is what you should practice for sure. There are 3 illustrations, I understand, but illustration number 9 for sure you should practice on page 2.39. So your homework is illustration number 9, page number 2.39. Okay. Nandesh is saying, yes sir, I missed the last session, I think 20 minutes because of the network issue. And see, this illustration number 7 was towards the later part of the session, if you have missed that. But that should not really be a problem. Just go back to the recorded version and you should be able to understand that. And you can also solve this on your own. That's not very typical. But please attempt that. That's very, very important. Okay. Now we'll move further onto this partnership and we'll pick up some more situations which are possible. Just give me 1 minute. I'm receiving some queries from you. Let me just understand some of your queries. Vijay is asking, sir, how to compute if B and C's excess capital do not match. Once again, you will do the same thing. If they do not match, remember for 3000 and for 1500, what did I do? You will recompute their basis. I think you didn't look at it. For B and C, when it came out to 3000 and 1500. Now, once again, what did I check? I checked whether it's in their profit sharing ratio or not, which came out to 1500 as a base for both of them. Okay. Let's suppose if this was 3500. And this was 1500. Okay, or let me just say this was, let's suppose, 2000. This, let's suppose, is 2000 and this is 4000. Yeah. Now, in this case, can we say it's in their profit sharing ratio? No. So, once again, what do? We will pick up this one as the base. And we will recompute the amounts. So, what do we get? 1500 into 2. 3000 is what we will get. And this will be 1500. So, now what will be the excess capital? This minus this. 1000 will be the excess. So, in this scenario, what will happen? First of all, B will be paid to the extent of 1000. Then B and C will be paid to the extent of 3000 and 1500. Then A, B and C will be paid to the extent of their capitals. Clear? Simple. Yeah. Okay, so now you can just move on to page number 2.71, and we can just look at certain steps to understand some of the points related to partnership. Okay. Vijay Shankar, I'm hoping you're clear on this. Sheikh is asking, will it be mentioned in the question as to which method we should use? Yes, of course, it will be specified, because that assessment you will not be able to do. That assessment will not be required. That is something which will be mentioned in the question, that this is the method you will be required to use to compute these amounts. Okay. Vaishnavi, we can come back to your query at the end of the session, or maybe at the end of the session you can just let me know the specific point in respect of this. What is your query, and we can get back to you. So moving further, if you can just open your study material, please, all of you, quickly. If you can open your study material quickly, can you do this? Aditya is saying, so the last page of the chapter is 2.69. So I'm not really looking at the chapter. This, I understand, is unit number 2, Aditya. And anyways, this module, if you open, I think this module is module 1. Okay, module 1. This is module 1. And this is page number 2.71. And once again, I'm not sure if you're referring to the old material or the new material. You can just download it from the website. It's available on the ICAI's website. Quickly now. Okay, clear? Amalgamation of partnership firms. So what do we mean by this? Ayush is saying the study material does not have page number 2.71. Let me just check why you're struggling to find this page number. Just give me 1 minute. You need to move on to unit number 2. On partnership, it's unit number 2. Therein, it starts with 2.70 only. Okay. I think that must be the confusion to all of you. It's unit number 2. Okay, so Ayush is clear. Great. So now we were talking about another type of situation wherein the partnership firm comes to an end. Comes to an end means similar to the situation we discussed. But after this comes to an end, the next step on the partnership firm will be that it gets taken over by another partnership firm. It gets taken over. Just 1 minute. It is taken over by another partnership firm. And how is this possible? Let's understand. Say there was a partnership between A, B, and C. C doesn't want to continue with the partnership. So what will happen? The partnership firm A, B, and C will come to an end. And when it comes to an end, what do we do? It will be dissolved. And how do we complete this dissolution? The same way we just discussed. Okay. After this, A and B continue to be in the partnership. So even though this firm will come to an end, the business will continue in the form of another partnership firm AB. So it shifts to a new partnership firm, or you can say a new partnership firm has taken over the business of the old partnership firm. Simple, easy to understand. Yeah. So let's understand some of the points around this. Closing the books of old firm. This is something we have done already. Each firm should prepare a revaluation account or this realization account relating to its own assets and liabilities and transfer the balance to partners' capital accounts in their profit sharing ratio. Something we did. Remember? Entries for raising goodwill should be passed. Assets and liabilities which are not taken over by the new firm. This is the new firm. Should be transferred to the capital accounts of the partners. Okay, that should be transferred to the capital accounts of the partners. The new firm should be debited with the difference between value of assets and liabilities taken over by it. The assets should be credited and the liabilities should be debited. Partners' capital accounts should be transferred to the new firm's accounts. So this is all about closing. As regards this new firm which is created. So this new firm will also be required to do the accounting. For this new firm, books of accounts will have to be started, which will be called as opening the books of new firm. Okay, opening the books of new firm. In this case, all the assets and liabilities which would have been taken over by A and B, that means new firm, would get transferred over here. Let's suppose assets in this firm had a book value of 1 lakh, but A and B agreed to take over these assets at 90,000. So these assets will get transferred over here at 90,000. So that means assets will not get transferred at book value. They will get transferred at agreed values. They will get transferred at agreed values. Okay. When it comes to the dissolution, A, B, and C will close their capital accounts. When they will close their capital accounts, they will also get to understand. They will also get to understand in relation to their capital accounts, what is the balance of B, what is the balance of A, what is the balance of C. Because A and B plan to continue, so that's why they will not take away any cash. But C is the retiring partner. It's the partner who is outgoing. So that's why C would want money if some balance is due to him. Or if some balance is due from him, then A and B would want him to pay and go. Clear? So the next step will be to credit the capital accounts of the partners with the closing balances. When one firm is merged with another existing firm, entries will be in the pattern of winding up of the books of the firm which has ceased to exist. The other firm will record the transaction as if it's a business purchase. I received one query around this. Radha is asking, say in your example, this one, partnership firm is not taken over. So how would this amalgamation come into existence? In our example, we have definitely taken over the partnership firm. See, it's taken over by another partnership firm. Okay, clear? Yeah. Then I received this query from Nandishwaram. Nandishwaram, just give me 1 minute. Just 1 minute. Huh? Nandishwaram is asking, sir, have the same partners A and B taken over the old firm, or is it that another firm has taken over? See, it's the same partners A and B which are taking over this old firm. But at the same time, please understand that once the old firm gets dissolved, even though some of the old partners continue that business by taking over the business of the old firm, even though there's no new partner, let's suppose, these are all old partners, only one of them has moved out, still this firm will be considered as a new firm. Why? Because the old firm is dissolved. It has come to an end. Clear? Okay. And we can just better understand this one by getting into one illustration. So we can look at one illustration. So let's pick up illustration number 3. Okay. Let's move on to illustration number 3. This is page number 2.79. Illustration number 3. X and company consists of partners A and B sharing profits and losses in the ratio of 3:2. So they are sharing profits and losses in the ratio 3:2. Next, firm Y and company consists of partners B and C sharing profits and losses in the ratio of 5:3. Firm and X and company has got partners A and B. The ratio is 3:2. Another firm Y and company consists of partners B and C sharing profits in 5:3. On 31st of March X1, it was decided to amalgamate both the firms and to form a new firm. So this is X and company, Y and company, they will be amalgamated, merged to form a new company, X, Y and company. Okay, yeah. In this new company, A, B and C would be sharing profits and losses in the ratio of 4:5:1. In this new one, clear? Balance sheet on this date, when this decision is taken, of X and company and Y and company are given. Yeah. And following were the terms of amalgamation. So let's understand. Goodwill of X and company was valued at 75,000. Goodwill of Y and company was valued at 40,000. Goodwill account will not be opened in the books of new firm. Means it will not go to this new firm. But it will be adjusted through capital accounts of the partners. Obviously, if this doesn't go to the new firm, this will have to be adjusted through the capital accounts of the partners. Building machinery vehicles are to be taken over at 2 lakh, 1 lakh, 74,000 respectively. And we see that building vehicle and machinery, building vehicle and machinery are appearing in the books of only one of these firms. So I got confused that if this is in the books of both the firms, then how will it be closed? Thank God. Provision for doubtful debts has to be created for X and company and Y and company. You are required to do two things. First, show how the goodwill is adjusted amongst the partners, number one. Number two, prepare the balance sheet of this new firm as at the date of the acquisition or the amalgamation, wherein the partners' capitals should be in their profit sharing ratio by taking B's capital as the base. You remember highest relative capital method? Therein we took least amount as the base. Herein they are asking us to take B's capital as the base for computing the partner's capital. The excess or deficiency in this case to be kept, that should be kept in the respective partners' current accounts. So that means in this case, current accounts will also be required to be considered. All right, clear? Now, before I get on to this new concept, let us try to understand about goodwill. Though I'm sure that you must have understood about goodwill, you must have read about goodwill. Still, we can just briefly touch upon that aspect related to goodwill. Whenever any business is taken over, let's suppose a company 1 takes over the business of company 2. So what will happen? Assets and liabilities of company 2 will get transferred over here. In return for this, company 1 will pay some price. This price is nothing but purchase consideration. Okay, this price is nothing but purchase consideration. Okay. Now, as around this purchase consideration, the purchase consideration amount is something which is paid for assets and liabilities. Yeah, it's paid for these assets and liabilities. Let us suppose the value of the assets and liabilities which is taken over is equivalent to 1,000. And the purchase consideration which has been paid against this happens to be, say, 1,200. So an excess amount has been paid. Now this excess amount is what? This excess amount represents goodwill. So in simple terms, we can say purchase consideration is 1,200 less assets, or we can say net assets acquired 1,000, and then what do we get? 200. This is nothing but the goodwill. And what does this goodwill represent? This goodwill basically represents the amount in excess paid by this acquiring entity or the acquirer. Why? Because of the valuation of the business, which is not really equivalent to the book values. This was the book value, correct? It goes beyond that, and something intangible is also achieved out of it. That's why this price is paid. Clear on this? Now, another aspect. This purchase consideration is not necessarily paid in cash by this company to this another company. This may also be paid through any other mode. So either it can be cash or it can be through issuance of equity shares or any other mode. So I've just brought in the concept of amalgamation for the time being over here. Now this concept will be briefly applied in our example also. Yeah. So now with this understanding, we will get to the solution of this illustration number 3. All of these profit sharing ratios you should remember. So let's move on to illustration number 3 solution. So what's the first step that we need to do? We need to first of all understand that with this revision, because now A, B and C will be getting something more, or we may have to pay something in terms of getting into this new firm. So let's try to compute the amount of the capitals or this entire adjustment which will be required to be done on their part. So for this, what do we do? So for this, we will look at the adjustment for raising and writing off of goodwill. Adjustment for raising and writing off goodwill. Because this is also required by the question. It's saying how the goodwill will be adjusted in the books. So first of all, goodwill will be raised in the books of old firm. What's the amount? It's 75,000 for X and company. For X and company which had A and B. 75,000 is the total. How will the 75,000 get distributed between A and B? In their profit sharing ratio. So what's the profit sharing ratio for A and B? 3:2. 45,000, 30,000. Old profit sharing ratio. Correct? Number 1. For Y and company, what's the amount? 40,000. Amount is 40,000. Oh, sorry, I'll have to bring in another partner. I'll bring in C over here only. Yeah? So this will be 40,000. And in this case, we don't have A. And this will also be distributed in their profit sharing ratio. What's their profit sharing ratio? 5:3. Old profit sharing ratio 5:3. So what do we get? We will get 25,000 and 15,000. So if the old partnership firms would have continued, then A would have got 45,000 against goodwill, B would have got 30 plus 25 against goodwill, C would have got 15,000 against goodwill. So the total which they would have received would have been 45,000, then 55,000, then 15,000, and then what do we get? We get 1,15,000 over here. This is under the old scenario. Now, under the new scenario, means under this new profit sharing ratio, what is required to be done? When these partners will get the goodwill amount, what's the accounting entry which will be passed? Goodwill debit to partners capital. Say A, B, C. So goodwill will be 1,15,000 debit to A, 45,000, to B, 55,000, to C, 15,000. Okay. This is how accounting entries would have been passed. Prakash is asking, sir, what if there was profit or credit amount instead of debit amount? So this would have been other way around. Okay, just look at the accounting entry. Now the goodwill is getting generated, then the goodwill will get reversed, and we'll also look at that adjustment. Okay. Now, what is required to be done? Question says that goodwill will not continue in the books of new firm. It has to become zero. But in the old firm, we will have to generate the goodwill. It's generated, it's transferred to the partner's capital account. Now we need to reverse this. When the new firm will take it over, it will reverse this. And when it will reverse this, it will transfer it to the partner's capital account. But when it will transfer this to the partner's capital account, this will be made in the books of the partners in the new profit sharing ratio. So this will be written off in new firm in new profit sharing ratio. So 1,15,000 in the ratio of 4:5:1. So what do we get? 46,000. Then we get 57,500. Then we get 11,500. So all in all, this will be 1,15,000. So let's see what will be the accounting entry over here. Partners capital account debited A, B, C, 46,000, 57,500, 11,500 to goodwill 1,15,000. So that means this will be another entry. Correct? Yeah. With this, what will happen? Goodwill will become zero, and net there will be some settlement in the accounts of the partners. Clear? So let's move on to that adjusted amounts of the partners with this goodwill amount. So what's the difference? Difference means this is A, and let me just put it as 1, and let me just put it as, say, second. So 1, 2. That's the difference. Correct? So if we say this was credit, this was debit, so this will be 1,000 debit. This will be 2,500 debit. This will be 3,500 credit. Net it's 0. Vijay Shankar is asking, sir, what if the goodwill is raised in the books of new firm? Then this column will not appear. This column will not appear. Okay, these two columns will go off if the goodwill has to continue in the books of new firm. Clear? Sheikh has a concern. Sheikh is saying, sir, we need to move at a faster pace. So I think we are moving quite a bit fast. If you just want me to increase this further, I think we may just start losing out on some of the concepts also. But still, if all of you believe we should again, move at a faster pace, please let me know. We can definitely move faster than this. Yes, moving further on to the next requirement, that is about balance sheet. Balance sheet of this new company or this new partnership firm, X, Y, and company. This is now required to be prepared. Correct? Yeah. So we'll move on to the balance sheet also. But for the purposes of balance sheet, we will also need certain adjustments. So what we can do is we can open the balance sheet of the new firm, and alongside we will keep doing some workings. Quickly, if you can go to the balance sheet, please. Balance sheet of X, Y, and company. XY and company as at 31st March X1. Okay. Yeah. So this will be based on the existing balance sheets. Huh? So let's see what all amounts will come here. Cash in hand and bank. This was 40,000 and 30,000. Okay. So what do we include? Cash in hand and bank. $40 plus $30. So this becomes 70,000. Correct? Next, debtors 60 plus 80. On debtors, it's 60,000 plus 80,000. And please remember, for debtors, it required provisions to be created, 5,000 and 4,000. Minus 5,000 minus 4,000. So what do we get? For the debtors, what is the amount that we get? For debtors, we will get 1,31,000. Okay, yeah. So I'm just using the old balance sheet and putting down this one. Okay. Then stock. This was 50 and 20. This is 70,000. Then we have next item as vehicles. On vehicles, the question says those are taken over at 74,000. So it's the new firm, so it will come at 74,000. Correct? Machinery, it's taken over at 1 lakh. Building taken over at 2 lakh. Goodwill is not appearing over here. So let's go to the liabilities side. Capitals, we need to come to this. Reserves, we need to come to this. Creditors are 1,20,000 and 1,22,000, 1,20,000 and 55,000. And there is no adjustment in this case. Okay. So there is no adjustment, but before that we can just leave some space for capital of one of these three partners, including their current accounts, which are required to be given separately. Capital account A, B, C. Current account. On current account, once again, we remember there was a point for A, B, C. A, B, C. And then creditors would be 1,20,000 plus 55,000. So this would become 1,75,000. Now, up to this stage, everything has been okay, and effectively we have been able to solve majority part of the question, isn't it? In fact, all of these workings have shown over here only. But one thing is missed. What is that? Computation of capitals of ABC. Computations of capital of ABC. Correct? So for this, we will need to get to the working notes. Yeah. So I'll use this space for the working note. So working note number 1. Where is this required? For the computation of capital accounts. Okay. Yeah. First of all, we will have to close the books of old firms. So I'll look at X and company. I'm looking at X and company, which had 2 partners, A and B. Their balances as per last balance sheet are given as 1,50,000 and 1 lakh. Their closing balance are 1,50,000 and 1 lakh. Then they also had reserves 50,000 in their profit sharing ratio. So this will become 30,000. This will become 20,000. So we are computing the capitals now. Okay. Now to this, what do we add? Revaluation of the building. Why? Because building is appearing in the books at 1,50,000, but it's taken over by the new firm at 2 lakh. So that means new firm has given 50,000 more to these 2 partners. Yes or no? New firm has taken over this building and paid 50,000 more for this building. So this 50,000 will go to whom? A and B. So revaluation of building. So 30,000 and 20,000. This 50,000, which is the addition, that will go over here. Prakash is saying, sir, why did you not take reserves? See, I have taken the reserves, Prakash. These are reserves only. I have taken the reserves. Okay. Yeah. Then machinery was taken over at a loss. So this 20,000 will be passed on. Revaluation of machinery. 12,000 loss and 8,000 is the loss. Clear? Then the provision debtors will not realize to the extent of 5,000. So that will also be passed on. Provision for doubtful debts. 5,000. Sorry, this is total 5,000. So this is 3,000. So what would this amount become? 195 and 130. So this becomes 1,30,000. This becomes 1,95,000. Okay. Yeah, clear? Similarly, we will compute it for Y and company. Its computation is there in the question. So I'm not getting onto its computation, please. It's the same adjustment. Yeah, I'm hoping you will be able to do this, or you can do this quickly. Computation of Y and company. So it comes out to 87,500 for B and 57,500 for C. So we have got the capitals of A, B in this X and company, B and C in Y and company, correct? Now we will look at their capitals in the new firm. So we'll start with their opening balances or with their balances. So working note number 2 will be for Y and company, and that's why I'm making it as working note number 3. Clear why I'm making it as working note number 3. 2 will be for Y and company's workings, which you will do. Okay. So balances of capital accounts, this will be X, Y and company. So we have C, we have B, and then of course we have A. So their opening capitals. Opening capital balances. So this is 195 for A, which we computed. 1,30,000 for this, which we computed, and this was working note number 1. Then the opening capital balances, which will come from working note number 2. It will be B. It is 7,500 and 57,500 for C. Clear? Yeah. Then the adjustment will come for goodwill. This comes from the adjustment working. Goodwill adjustment will be given on a net basis. We are showing it. Gross is shown in that adjustment. So over here we are just giving the net adjustment 1,000, 2,500 and 3,500. So 1,000 will get reduced from this. 2,500 will get reduced from this. 3,500 will get added over here. Okay. Yeah. So what do we get? We get 194, 215 and 61. 194, 216 and 61,000. So these are the capitals. Now the question says that these capitals should be in their profit sharing ratio. Remember, question says these capitals should be in their profit sharing ratio, wherein B's capital will be kept as the base. So if we take B's capital as the base, what do we need to do? We will multiply capital of all the partners with this capital. Correct? We will multiply capital of all the partners with this capital. That is how it will be computed. Yeah. So if we get on to this computation, wherein B's capital is kept as the base, what do we get? 1,72,000 will be the capital of A. This will of course be 2,16,000 because this was kept as the base, and 43,000 should be the capital of C. Now the differences between these two will be the shortage or excess. This is 22,000. This is excess. Where will it go? Current account. So the question said that any excess or deficit will go to current account. And this was 43,000 required, again 61. So 18,000 is the excess. So this 18,000 will also go to current account. So all in all, what do we get? We can give the working note reference over here. Yeah. So what are their capitals now? 1,72,000. Then we have 2,16,000. Then we have 43,000. So these are the required capitals and in their profit sharing ratios. And what are the differentials? 22 and 18. These are also their capitals. So this is 22. For B it's nil. For C it's 80. All in all, this is how our balance sheet will get closed. 6,45,000. 6,45,000. Clear on this? Sheikh is asking, sir, why we are adjusting the revalued amounts in the capital account and not in the P&L? Those will get adjusted with the capital only. Durga Devi is asking, sir, what about vehicle? Vehicle will come in working note number 2 when you will do this for YD company. See the working note number 2 I have not prepared. That is for you. Prakash is saying, please tell us how you calculated revaluation of building and machinery. Very simple. For building, the revalued amount is 2 lakh. And what's the book value? What's the book value? 150. So 50,000 is the revaluation. Okay. Oh, so I think I've written something wrong. Oh, so this is 2,15,000. Huh? So sorry, this is 2,15,000. And thanks for letting me know. This is 2,15,000. Okay. Aditya is saying, sir, how did you get 1,72,000, 2,15,000 and 43,000? It's very simple, Aditya. Just keep 2,15,000 as the base. So do this. Take this as the basis. Okay. Maybe if you want to just solve this, let's look at it. I'll clear this part. Huh? Now in this case, what do we understand? 2,15,000 is the base. So what can you do? 2,15,000 into 2,15,000. What's their new profit sharing ratio? 4:5:1. For A, B, C, it's 4:5:1. For B, it is 2,15,000. Yeah. So 2,15,000 will be multiplied with what? 2,15,000 will be multiplied with 4. So what do we get? You can compute this and let me know quickly. Quickly. What will you get? Let me just compute these amounts. Two lakh 15,000 into 4, we get 8,60,000. Okay. 2,15,000 is the base. Let's come back to its computation, or otherwise I think this will become a lengthier method. So let's ignore this method. What you can do is just look at it once. You should keep total capital. What's your total capital? Your total capital is 194 plus 215 plus 61,000. Let me just write it. 194 and this is 61,000. So these are the actual capitals right now. Correct? Now, as around these actual capitals, you want to keep this one as the base. So if you to keep this one as the base, if you look at the total of your profit sharing ratio, this is 10. 4 plus 5 plus 1. Yeah. So now, what are we trying to achieve? We are trying to get into the profit sharing ratio for all of these capitals also. Now, B is holding 1/5 of the capital. Sorry, B is holding half of the capital. Why do we say this? 5 divided by 10 is the share of B, or should be the share of B, if this capital has to be kept as the basis. Correct? Or in other words, we can say what should be the total capital. Currently, the total capital is what? Total capital is 4,70,000. This is what I computed. Huh? Please correct me if I'm wrong. And what should be the total capital? This is actual. Should be means this is 4,30,000 and this should effectively 2,15,000 into 2. Why we are giving it into 2? Because other two partners A and C will hold 2,15,000, because 2,15,000 will also be held by B. So all in all, if we do this, then it would become 4,30,000. Out of 4,30,000, 2,15,000 will be held by B. So which means 2,15,000 which remains has to be distributed between A and C in their new ratios. So what are their new ratios? Let's try to compute it simply. What are their new ratios? 2,15,000. Let me just compute it. So this comes out to 1,72,000. And for C, now what can we do? We can very simply assign the balance amount over there. What's the balance amount? The balance amount comes out to 43,000. Or you can compute it for C also. Or you can compute it for C and compute the balance for A. Clear? I think many of you have already solved this and shared the workings, which is good. Ayush is asking, sir, even if the question is silent, we still have to consider B as the base because B has the no. See, this working of keeping any of the partners capital as the base capital will only be done if the question specifies. If the question, let's suppose, is silent on this point, you will end it over here. You will not do this working, okay? So this part which I have deducted, you will not do this. You will just simply take A's capital as 194, B's capital as 215, and C's capital as 61,000. Clear? Yeah. So what we can do is we can take a break now, and after the break we will continue with our discussion of this. And in the meantime, if you have any queries, you can just keep sending your queries. I see a lot of your queries were related to this computation only, which seems to be done. Huh? Okay, great. Great. So let's take a break and let's continue after the break. Hi, welcome back. So we can now continue with our discussion and we can move on to another illustration. Would suggest if all of you can move on to illustration number 7. Okay. Yeah. And I see some of your queries which still continue. Okay, so before I move on to this new illustration, quickly getting back to the queries, I think there's a lot of confusion around this computation of amount. Huh? So this one, this one, this one. So let's look at it very simply. Again, I'm not sure why you're so confused, but still, let's keep it very, very simple. Huh? These are the actual capitals. And let me just remove this for the time. And you need to just confirm me quickly. Huh? These are the actual capitals. I'm hoping that there's no confusion up to this stage. Quickly. These are the actual capitals and there's no confusion up to this stage. Correct? Yes or no? Yeah? Please confirm. Is there any confusion up to this stage? Up to the actual capital? Yes, I'm waiting for your response. Do you have any confusion in relation to these amounts of the actual capital? No. This is what Nandishram is saying. Okay. Now, it's not required as a concept. It's required as per the question. So question is saying, keep these capital as the base. There's no logic behind this. This is what the question says. So I'm not following any logic. I'm just simply following the requirements of the question. Question is saying, keep these capital as the base. And keeping this capital as the base, make sure that the capital of these partners are in profit sharing ratio. Okay. Now, if B's capital is the base, what's the profit sharing ratio of B? 5 out of 10. What's the profit sharing ratio of A? 4 out of 10. C is 1 out of 10. Correct? Yeah. So this is the profit sharing ratio. And once again, this is given in the question. So I'm not doing anything about it. B's capital is what? It should be, let's suppose X. B's capital is X. Sorry, let's suppose the total capital is X. Let's suppose total capital is X. So what will be the capital of B? 5 divided by 10x. And what is the capital that should be there for B? It will be 215. Why? Because it's the base. So the base will not change. So this is 2,15,000. So what do we get? X will become 4,30,000. X will become 4,30,000. So that means we have got the total capital. Capital which should be kept in profit sharing ratio, taking B's capital as base, will be 4,30,000. Simply, yeah. Now, I need to allocate this 4,30,000 to A, B, and C. So what do I do? 4,30,000 into 4 by 10, 4,30,000 into 5 by 10, 4,30,000 into 1 by 10. So this will become 1,72,000. This should become 2,15,000, and this should become 43,000. Radha is saying, sir, why the actual capital is A and B? For this, we have done a lot of computations. I think you need to go back to the computation because that is all based on the working notes number 1 and 2. So now we should move on to next illustration. See, we are continuing with our discussion in relation to the principle where the firm is taken over by another entity. Now that another entity could be anything. It's not necessary that firm is taken over by another partnership firm. Firm may be taken over by a sole proprietor, firm may be taken over by a partnership firm, or firm may also be taken over by a company, a private limited company or a public limited company. So let's suppose ABC and company, which is a partnership firm, is taken over by a company, say a private limited company. Now in this case, what will happen? Everything will remain same. This will have to be dissolved, and once the dissolution is done, assets and liabilities of the firm will move on to this new company, and as against this new company will pay cash, which is the purchase consideration, or it may also issue its equity shares. Yeah. So this purchase consideration could be paid by this new company in any form. So it doesn't really matter. Correct? Yeah. Now we will move on to another illustration to continue with our discussion in relation to similar type of principles. Illustration number 7 on page number 2.94. Okay. Nandishwar is saying when the question is not mentioning about the base, you will not take anything as the base. You will just keep actual capital as your capital. You will not get into this type of working. Prakash is saying, sir, how did you get 4,30,000 as the actual capital? No, that's not the actual capital. That's the capital worked out as per the requirements of the question. That should be capital, not the actual capital. A, B, and C were in partnership sharing profits and losses 3:2:1. There was no provision in the agreement for interest on capital or drawings. A died on 31st of December X0, and on that date, partners' balances were A, B, C capital accounts are given, A, B, C current accounts are also given. By the partnership agreement, the sum due to A's estate means the heirs of A, because A died, was required to be paid within a period of 3 years, and the minimum installment of 20,000 each were to be paid. The first such installment falling due immediately after it, and the subsequent installments are after every 6 months. Interest at the rate 5% per annum was to be credited half yearly in respect of the amount which has not been paid to estate of A. In ascertaining his share, goodwill, which is not recorded in the books, was computed at 60,000. Okay. And the assets, excluding the joint endowment policy, were valued at 36,000 in excess of book value. So whatever was the book value, they were revalued, and 36,000 was the excess value. Means revalued amount got increased by 36,000. And herein, joint endowment policy was not considered. No goodwill was raised and no alteration was made to the book value of fixed assets. So goodwill is only for the purposes of computation of partners' capital. Actually, it was not raised. The joint assurance policy shown in the books at 20,000 matured on 1st of January X1, means the day when sort of this partnership came to an end, realizing 26,000. So out of the joint insurance policy, 26,000 have been realized. In the books, they were appearing at 20. Out of this, 20,000 were paid to A's executors on 1st of January 2000 X1. And of course, the other payments were also made to A's executors on 30th June X1 and 31st of December X1, means after every 6 months. B and C continued trading on the same terms as previously, and the net profit for the next year before charging the interest due to A's estate amounted to 32,000. During this year, partners' drawings were 15,000 and 8,000, means B and C. Next year, means on 1st of January 2000 X2, partnership was dissolved and an offer to purchase the business as a going concern for rupees 1,40,000 was accepted by the old partners, means B and C. A check for that sum was received on 30th June, means after 6 months, a check was also paid for the purchase consideration for the business of the firm. The balance due to A's estate, including interest, was paid on 30th June. Means when this purchase consideration got received, that time the balance was paid, and on that day, B and C received the sums due to them. You are required to write up partners' capital accounts, partners' current accounts, starting from 1st of January X1 to 30th of June X2. You should also show the account of A's executors. Okay. Account of A's executors is required to be shown. So it's a bit lengthy one, and there are a lot of workings which will be required in this. So what I'm doing is I'm just starting with partners' current accounts, partners' capital accounts, and A's executors accounts. And we'll see as to what all workings are required. Some of these workings we can just pick up from the study material directly. Okay. Yeah. So partners' current accounts, A, B, and C. C, B, A. Oh. Then the next one will be the partner's capital accounts, for which you can use the space. Okay, and then I'll prepare A's executors account. Aditya is saying, sir, why are they asking execution accounts? Are we doing death of a partner or amalgamation? See, it's both. In this case, there was a death of a partner because of this partnership came to an end, and the account of the partner is not really settled. Why? Because its executors will get the money. And after that, amalgamation has also happened. Okay, so it's included there. And anyways, you can't just challenge the requirement of the question. The question may ask you anything. So you should be prepared for everything in the exam. Akansha is saying, what could be the time limit in relation to the marks to attempt such partnership questions in the exam? That will be dependent on the all the questions, basis which you will plan. What is the marks, what are the marks which are allotted to each and every question, and depending on the weightage which you will assign to all the questions, you'll have to consider the weightage of this type of question as well. Okay. So now moving further, we are having opening balances of all of these partners. So A, B were having credit and C was having debit balance. So 1st of January, X1 by balance brought down. This was 29,000, 20,000, and over here 1st of January, X1 balance brought down. This was 5,000 for C. Okay. Then we can also post the accounts of partners' capitals. This is 60, 40, 20. 60, 40, 20. Okay, yeah. Then moving further, what's the first adjustment? It's for goodwill. First adjustment will be for goodwill. So if you'll see the adjustment for goodwill, what's the adjustment for goodwill? So 20,000. So it says in ascertaining the share. Let me just move on to the workings also simultaneously. See, unfortunately, I don't have the space. So I'll just take you to a working note. You can go to working note number 1. If you can go to working note number 1, please. All of you, quickly. Can you go to the working note number 1? Yeah. Share of goodwill for all of these three partners will be what? 60,000 will go to A, B, and C in their profit sharing ratio. 30, 20, and 10. And after this, what will happen? After this, what will happen? This goodwill will have to be closed. Why? Because this goodwill will not be carried further. Correct? So this closure of goodwill will be done in the accounts of whom? B and C. Why? Because A is no more. So A will carry the amount of 30,000 in relation to goodwill. B and C will have to forego this amount. They will have to sacrifice this amount to the extent of 30,000. There will be an adjustment. Correct? So 20,000 of this portion will go to A. 30,000 of this portion will go to A, which will come as 20,000 from B and 10,000 from C. So if you look at A's current account, what will happen? It will get added. So by B's current account, by C's current account. So 20,000 and 10,000. Okay. 20,000 and 10,000. Yeah. And to the extent of this amount, this will get reduced from current accounts of B and C. 20,000 and 10,000. So goodwill has got adjusted in their accounts. And with this, we have also looked at our first working note. You can give the reference of working note over here. Working note 1, working note 1, and of course, working note 1. Okay. Now moving on to the next adjustment is about revaluation. Now for revaluation, once again, we should go to the working note number 2. 36,000 is the revaluation gain, which will get allocated to A, B, and C in their profit sharing ratio. Look at the working note number 2. 18, 12, and 6 will get allocated to A, B, C. Yeah. And the impact of this revaluation, will once again be adjusted in the accounts of whom? B and C, because they will have to settle the account of A with this. Yeah. So in their profit sharing ratio, this will be adjusted. So once again, what do we do? By B's current account, by C's current account. So B and C will require adjustment of 12,000 and 6,000 for this. To A's current account. This is working note number 2. 12,000 and 6,000. Here again, you can give the working note number 2. And I'm just clearing this partner's capital account for the time being. I'll come back to this one later on. I think otherwise we'll not be able to put down everything in relation to the current account. Okay, so now adjustment in relation to revaluation is done. Moving on to the next adjustment, that is about joint life policy. 26,000 have been realized out of 20,000 book value. So 6,000 will be required to be distributed. 6,000 will be required to be distributed, and this will be distributed to whom? This will be distributed to A, B, and C. So we'll say by joint life policy. 3,000 goes to him, 2,000 goes to him, 1,000 goes to him. Okay. So this is also settled, joint life policy. And in respect of the adjustments in relation to the day when this partnership has to end, means 1st of January X1, what can we do? We can close the accounts. We can settle their accounts. Because after that, a new firm will take it over. So we can settle this account. So we can say by balance carried down, this becomes it is 10 and 20 for B and C. Yeah, and this is 80,000 for A. Now for A, we will not keep in the current account. This will be transferred to the capital account of A. Why? Because A is gone. To A's capital account. So current account of A will get closed with this. Okay. Current account of A is closed with this. Now we will move on to the capital account. And we will also close the capital account in the first year. In fact, sorry, on the opening day. Capital accounts. This was balance brought down 1st of January X1. The balance brought down was 60, 40, 20. And this balance will increase by A's current account. 80,000 has got increased over here. And now from the current account, it will shift to its executors accounts. 1st of January X1 to A's executors account. And what's the total? 1,40,000. To A's executor account. Sorry, this is because of the space constraint. 1,40,000. This becomes nil and this becomes nil. Yeah. The balances of the other partners will continue. Two balance carried down. This will be 40,000 and this will be 20,000. So on this particular day, we can close the capital accounts of the partner. Yeah. And now on this particular day, we can also go to A's executors account. A's executors account. Now A's executors account will get credited on 1st of January 2000 X1. Sorry, this is by A's capital account 1,40,000. Correct? And on this particular day, 20,000 will be paid to A's executors. To bank, 20,000 will be paid. To balance, carried down 1,20,000. Clear? Yeah. Now moving further. Aditya, I'll come to your query slightly later, please. Let's get done with this. Because there are few adjustments in this which we need to discuss. Otherwise, it's all very simple. Huh? Now, moving further with this, on to the end of first year. Now, for the end of first year, I will have to move on to this current account as well as capital account. Yeah, and I'll just clear this part. So on 1st of January X1, we will move these balances over here. Yeah, so I'm just moving these balances over here. Correct? And I'm just clearing this part because I'm continuing with this one. Huh? Now for A, it will not be anything. In fact, A will not exist anymore. So in fact, I can also take out A. It will be B and C in the current accounts. B and C in the current accounts. Similarly, I can take out A. It will be B and C in the current accounts. Now for the year, we have to move. So the balances which we carry will be 10,000 and 20,000. Now during this year ended 31st December 2000 X1, let's see what is the profit or loss. During this year ended, we need to compute the profit or loss. So for this, what do? We will go to working note number 3. All of you, if you can go to working note number 3, please. Profit is given to us for this year amounted to 32,000, but that is before charging interest. Interest to be paid to A's executors. So I think we should compute the interest that would be paid to A's executors during the year. So let's compute it. On 1,20,000, first of all, interest will be paid at the rate 5%. So we will say on 1st of January X1, by balance brought down 1,20,000. On 1,20,000, 5% will be the rate of interest. What was the rate of interest? 5%. So 1,20,000 into 5% is 6%. Sorry, 6,000. For half a year, it will be 3,000. So 30th June X1 by interest, it becomes 3,000. It is 3,000 in half a year. On 30th June X1, again, the payment will be made equivalent to 20,000. So what's the balance? The balance will be 1,03,000. 1,03,000, which will again then continue over here. 30 June X1 by balance 1,03,000, and on this 1,03,000 now once again 5% interest will be computed. What does it become? It becomes 2,575. Interest is 2,575. And which will again be paid on 31st of December X1 to bank, to balance carried down. So 20,000 will be paid over here. and therefore we will be left with a balance of 85,575. Okay, but what did we want from this? We wanted interest. So interest has been paid to A's executors equivalent to 3,000 and 2,575. Correct? Now from 32,000 we will reduce 5,575. So what do we get? 26,425. So this will be allocated to whom? B and C. So during the year ended 31st December X1, is there any other transaction? No. So on 31st of December X1, by P&L appropriation, what do they get? What do they get? 26,425 in their profit sharing issue. So this becomes 17,617 and this becomes 8808. Okay, and with this, their closing balances will become, I think they also had some drawings on 31st of December. Yes, they also had some drawings on 31st of December, 15,000 and 8,000. On 31st of December X1, two drawings, 15,000 and 8,000. So now what will happen? With this, their closing balance will be cut down. So this becomes by balance carried down 7383 and this will be 19192. Okay, yeah, this will again now move on to the next year. Next year again the profit will be added and next year again the interest will be computed, and for which you will have to now get into the workings related to the realization. Now next year, after this year, what is going to happen? After this year, what is going to happen? On 1st of January 2000 X2, that means on this date, this business is taken over by another company. Okay. Now when this is taken over by another company, now what will happen? Now all of these capital accounts will get shifted to that company. Correct? Yeah. So let's see now what's the next step. Next step will be to compute the realization gain or loss. Again, same way. So what I'll do is again I'll carry these balances. So we are now on 1st of January 2000 X2. And I'll just carry these balances over there. This is 7383 and this is 19192. Now, let's try to understand the computation of realization. For this, we need to go to working note number 5, please. Purchase consideration which has been received is equivalent to 1,40,000. Against this, what is the total value of assets? 1,19,000. How can we compute it? When we look at the sundry assets value in working note number 4. From this, what do we reduce? A is executor's interest because that will be a liability. And from this, the partner's capital account, they will also be required to be reduced if those are required to be paid off, or we can say they will become the balancing figure over here. Either way we can look at it. Yeah, clear? Partner's capital account will be in respect of the realization gain or loss. Correct? So what does it become? 12,573. So by realization gain, he is getting 12,573 and C is getting 6,287. And with this, the account of B and C will get closed. A's executors will continue in this pattern till 30th June 2000x2, when they will also be paid off completely. And on 30th June 2000x2, this capital will also come to an end. So now, because we have moved towards the end of our session in terms of the timing, so that's why I would request all of you one thing. Please complete this small part which remains. Okay. And if you find any problem, please note down the specific problem and we can have a discussion on that in the next session. All right. Clear? And now, all of you, whatever queries that you had in the last session, in respect of the illustrations that you have practiced, or in respect of the illustrations that you would have practiced as homework, please mark your illustration and give me the specific query. Okay, so now you can just post your queries over here. I'll be able to track it accordingly. Clear? Yeah. So two things for all of you. One is the homework which I gave, and second is completion of the small part which remains. All right. Yeah. So with this, I would like to thank you once again for your time and for your wonderful participation today. And in the next session, when we'll meet, we'll complete this partnership in terms of certain part that remains, and we'll also start with a new topic in the next session. Thanks to all of you.